All right, the Federal Reserve is reaching inside its toolbox to fix the potential inflation situation next year. For a closer look at the tools the Fed is using and the inflation situation, let's turn to Vince Reinhart, former director of the Fed's Monetary Affairs Division and now a resident scholar at the American Enterprise Institute. He joins us from our Washington newsroom with his perspective. Vince, thanks for coming on the show. Let's talk first about what the Fed is doing, because it is a very complicated issue for a lot of people to understand. What does it mean to say the Fed is going to sell term deposits to absorb excess reserves?
Yeah, they're not just reaching into their toolbox, they're making new tools. And the latest tool is a term deposit. What people worry about is that the Fed has too many reserves outstanding. Reserves are what make money creation possible. It's what banks use. It's what we refer to as liquidity. And so what the Fed is going to do is convert some of those reserves into term deposits. Funds sitting in the account at the reserve banks, of commercial banks holding them at the reserve bank, but they don't count as reserves. So they'll be able to shrink the amount of reserves without having to do it the old-fashioned way.
Why is the Fed concerned about the prospect of inflation when Ben Bernanke has basically said in front of Congress that as long as these reserves are sitting at the Fed, they don't increase the velocity of money and therefore boost prices?
Yeah, so I'm actually not sure the Fed's that worried about inflation. They got an outlook in which the unemployment rate stays high for a while, and in that environment, inflation is probably flat, maybe even tilted down. What they want to do is convince everyone they have a plan so that they shouldn't be worried about inflation. So that's why they talk about the exit strategy a lot. You talk about the exit strategy not because you're about to head for the door, but you want to reassure investors not to worry about it.
Now, Ben Bernanke says that this will not have any effect on monetary policy, but isn't it a reversal, really, of the quantitative easing that was used after we had already brought rates down to as low as we could go?
Sure. No, it is monetary policy. Quantitative easing is an aspect of monetary policy. It's making your balance sheet big and changing the composition of it to affect markets and the economy. If they start changing the composition of their balance sheet by issuing term deposits, that will have some consequence. Main one being there'll be fewer reserves in the banking system. Banks will be holding deposits at the reserve bank, which don't count for reserve requirements, rather than official reserves.
All right, so what's next after this? I mean, does the toolbox start to get emptier and emptier? Which is the next one to pull out?
So what they're doing is changing the composition of their liabilities. They're converting some reserves into deposits. The next step is to actually shrink the balance sheet. And the way you shrink your balance sheet is you sell assets. They'll probably let some of the facilities run off, as they have been. They'll let some maturing securities run off. But ultimately, they'll probably have to shrink their sell assets to shrink their balance sheets. And that poses a risk for them.
And for the U.S. economy, I mean, does it pose a risk, for example, mortgage assets that a lot of banks are holding as well?
Oh, sure. Once the Fed starts removing the amount of policy accommodation, you'll see market rates back up. But presumably the Fed's not going to do it until it's confident that the recovery is on track and that the expansion's got traction.
And all of this happens long before the Fed raises rates. Is that the idea?
So hard question. They'll probably start raising rates with a big balance sheet. That is, they'll use those new term deposits to bring market interest rates up, even as their balance sheet remains big. So they've put themselves in the position to be able to raise rates whenever they want to. Given their economic outlook, they're probably not going to want to later in 2010. And
given their dual mandate, Vince, do you think it's possible that the Fed waits for a certain target on unemployment? I mean, do they want to see an 8 handle or even a 7 handle on unemployment before they start to raise rates?
They're going to need a forecast that has the unemployment rate decidedly pointed downward. They can't tighten policy when the unemployment rate is 10%. You're right, they got a dual mandate. It's not just that the unemployment rate's so high, it's they got a forecast in which inflation is very subdued. So once they start publishing forecasts in which the unemployment rate is dipping lower and inflation stops falling and actually is rebounding, then they'll have a reason to tighten. But they're not there yet.
All right, hey, Vince, thanks so much for spending some time with us today. Vince Reinhart there of the American Enterprise Institute.